Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, all eyes were on the American labour market until Trump shifted them to the trade war rhetoric. Firstly, the US payrolls data reported a gain of 201,000 jobs in August, right on expectations. Impressively, wage data showed a 2.9% year-on-year rise, and that was an improvement that wasn't expected. It was the largest rise since 2009. But there were some other signs worth noting. Prior month gains were revised down by a sizable 50,000 jobs. Their participation rate slipped when most thought it would be rising. And new manufacturing jobs actually fell in August when a big gain was expected. However, on the headline data, and especially the wage gain data, expectations of another Fed rate hike rose. The US dollar rose, and benchmark bond rates rose. In Canada, the headline jobs report was very negative, showing a loss of 52,000 jobs following 2 months of strong increases. But it might be not as bad as it looks. All the losses were in part-time positions. Full-time employment actually grew by 40,000 jobs. Still, the result was not expected, and they too saw a fall in their participation rate, even if it sits quite a lot higher than the US. Separately, a central bank official there said Canada's economy can tolerate more interest rate hikes. In Mexico, their August inflation rate edged up to 4.9% from 4.8% in July. There seems more official interest rate hikes are on the way there too. China released data on its foreign currency reserves, now more closely watched given the trade war they're in with the United States. Those reserves slipped a little more than expected, but are still comfortably above 3.1 trillion US dollars. China also released data for its trade balance in August, and trade growth slowed down significantly there. The export growth rate slowed to under 10% in August from 12% in July, while import growth moderated as well to 20% from 27% a year earlier. Exports to the US grew 13% in August from a year earlier to $44 billion, a faster rise than in July. The August trade surplus with the US widened to $31 billion from $26 billion in August 2017. Basically, it's only the US that can't seem to get its trade balance with China right. Almost everyone else can, including New Zealand. In frustration, the US president threatened to impose new tariffs on $267 billion more of Chinese exports to the US. It is being dubbed total tariffs. China may respond by matching export rebates. And there's more trouble for China. A number of countries are banning pork products as their swine fever infestation grows. In Australia, their unique superannuation industry has been caught with another rort. Funds have been automatically classing customers as smokers, resulting in higher insurance premiums when they upsell life insurance with superannuation membership. About 70% of all life insurance in Australia is sold this way. US Treasury 10-year yield is higher at 2.94% following the US payroll data. Their two-turn curve is a little changed, however, at just 24 basis points. The Aussie government 10-year is at 2.57%, that's up 2 basis points. The China government 10-year is at 3.65%, unchanged, while the New Zealand government 10-year is at 2.55%, that's down 1 basis point. New Zealand's swap rates have edged lower, with the 2-year rate now at 1.97. Gold is marginally weaker and now just on $1,196 an ounce in New York. That's down $2. The US oil prices are unchanged and now just under $68 a barrel, while the Brent benchmark is just under $77 a barrel. And the Kiwi dollar is starting the week 0.75 cents lower than this time last week at 65.4 US cents as the US dollar rises. On the cross rates, we're now at 92 Aussie cents and 56.5 euro cents. That puts the TWI at 69.4 and 60 basis points lower over the week. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.